Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we want to talk about taxes. We're nearing the end of the year in 2025, and we think that taxes are a very important part of what we do with our clients. We ask every client when they come to us to give us their tax return so that we can do an analysis in the beginning and encourage everyone to give us their tax return every year as time goes on. We think that that's very important in terms of the process. Our overall process, which those of you who are clients have seen before, uh, we are always looking at the tax implications. So when we start talking about retirement planning, okay, when you take Social Security, how are you going to take income out? All have
Right,
tax implications. How we invest for you, where are we going to put your investments in a taxable account or a
right.
qualified account? All have tax implications. Even the insurances, whether you're going to take money out of an annuity. And of course, estate planning has both income, capital gains, and also estate planning tax implications. So taxes
Yeah.
are really important. And we want to remind everybody, especially as we're nearing 2025, if there's anything that you think we should review, we're trying to meet with as many people as possible. Because
And
we want to talk about the major mistakes. Uh, Generally, we ask for your tax return to look at the pro forma
yep,
this year, but we also do strategic work where we're looking at your overall tax implications over the course of your lifetime. So we're
yep,
looking at it in both ways.
yep.
So the four mistakes that are listed on the next slide are about not grasping how your taxes will change, failing to create tax diversification, getting stuck with big RMDs, and the thing that Steve started talking about, which is the estate leaving money to your heirs. And so Steve's
Yep.
going to take the first one.
Yep. And so it's important to understand how your taxes will change. And again, there have been changes to the tax laws this year, and with some, pretty substantial results in terms of a lower tax bill if you're careful about the way you do things with respect to recognizing income in a given year and that type of thing. And so this new law was signed in on July 4th, and what it did is it actually extended a lot of the provisions from the 2017 law, including the marginal brackets, which are slated to increase to, for example, top bracket was going to go up to 39.6% in 2026 if these brackets had not been extended. But it also includes some new provisions in it too that are pretty interesting. But also, you have to be careful because you could lose some of these phase outs, which I'm going to talk about in a minute, if you're not careful in terms of how much income you realize in a given tax year. So, so these are the ordinary income brackets now. The 37% bracket for a married couple starts at 751,000. Now, I always want to explain to people what it means with a marginal bracket. A lot of people are confused by that. A marginal bracket doesn't mean that all of your income is taxed at that rate. It means that the next dollar is taxed at that rate when you exceed these dollar thresholds in terms of income here. Okay. So your average tax rate, for example, if you're in the 24% bracket, may only be 15% on all of your income. But the next dollar for a married couple over 394,000 will be taxed at a 24% bracket. That's what that means in terms of marginal bracket. Okay. And by the way, when we go through our planning process, we look at this and we look at what opportunities exist here to try to keep you in a lower tax bracket where possible. But ordinary income includes all these categories we have listed here, by the way. And I just want to mention there's two aspects to this in terms of phase outs. There's adjusted gross income, but there's also modified adjusted gross income. Adjusted gross income includes all of the things you'd think should be an income, but it doesn't include interest on tax-free bonds. But modified adjusted gross income includes things like income, interest on tax-free bonds. And by the way, that's used to determine how much of your Social Security is going to be taxed, by the way. So, which is an interesting thing. Okay. It's been that way for years, by the way. And so there's also something called qualified income and net investment income tax brackets. And so a lot of companies, stock from companies pay out dividends, and most of that's considered to be qualified income, which means it's taxed at a capital gains rate rather than an ordinary income rate. Okay. But there's some types of investments the income is taxed as ordinary income. For example, the income from REITs, real estate investment trust, for example, that's treated as ordinary income. Okay. But also, if you go to too high a level in terms of investment income, you're going to get hit by this additional 3.8% tax. This came into effect, I think, when Obamacare was passed, and I guess in 2010, I think it was passed. Okay, so we you have to be cognizant of that. And so it is also here we could get hit by something we call a tax torpedo. When you have arguments saying $10 additional income, suddenly you're in this ridiculously hard marginal bracket, one that doesn't really exist under the tax code, but but becomes effective because you're being hit by phase outs in some of the things you can deduct. So we have to be cognizant of that as well, by the way. Okay, so the standard deduction now is pretty high. 15,000 for a single, 15,750, and 31,000 for married filing jointly. Now there are opportunities here. So, for example, if you have certain medical expenses, by the way, and you can't get above this level because of the 7.5% threshold under which medical expenses become deductible. So, in other words, medical expenses are only deductible if they exceed 7.5% of your adjusted gross income. Okay, so if you have medical expenses, if possible, try to bunch them in 1 year so you can exceed that level. And also, if you exceed that level, you may also exceed the standard deduction, and you may see some value there. So that's another area of tax planning. It makes sense sometimes to try to bunch deductions up in 1 year so you can exceed this level, because otherwise you're not really seeing any benefit from it because you're going to get that $31,000 deduction anyway. So if you just hit, argument's sake, 30,000 and some of those that number came from expenses you can actually move into another year, you're probably better off doing that. So
And
it's an
that is one
opportunity
of
here.
these times where we might want to actually suggest a DAF, where
Yep.
you can increase your charitable deductions in
Yep.
all 1 year. You don't necessarily have to give it to the charity all in 1 year. So that is a time where we might want to recommend that.
Absolutely. Yep. That's a great point. Yep. And now you heard talk that they're going to try to make Social Security tax free. Unfortunately, because of the way this bill passed, it went through the reconciliation process. And in the reconciliation process, you don't have to have 60 votes in the Senate. And they knew they weren't going to get 60 votes on this bill. And unfortunately, the Senate parliamentarian said that based on the rules of the Senate, they couldn't actually eliminate the tax on Social Security in a reconciliation bill. I don't understand all of the rationale behind it. I haven't read up on it. It doesn't really matter from our view. But let's just say that they couldn't make it completely tax-free, but what they did instead is they allow seniors to deduct $6,000 per person. Okay, an additional deduction that's not related to the itemized deductions. But there's a phase out here, and this is what you got to be careful of. For example, a married couple with adjusted gross income above 150,000, you start to see this being phased out, by the way. And I don't have the exact phase out rate. I don't recall what it is, but probably around 250,000, I think, is when it's completely phased out. So there's an opportunity here. If you're going to declare income in 1 year, if you could move it to another year and stay below this level, if possible, it may make a lot of sense. So,
Right. So now we have to thread the needle. We're first of all looking at Medicare
yep.
premiums. Now we're also looking at the senior deduction. When we're talking about things like Roth conversions or doing anything that might create additional income for you.
Yeah, and again, you get hit by a tax, what we call a tax torpedo. So, and we have tools that enable us to graph the marginal brackets and also the average rates, and we can see how close you are to getting hit by that tax torpedo with our tax tools. So this is kind of an annoying thing about the tax code. If you look at this, the actual thresholds above which Social Security becomes included in your ordinary income, it becomes taxable, have not changed, I believe, since the early 1990s, believe it or not. These numbers are not adjusted for inflation. And so more and more seniors have found that their Social Security is actually taxable through the years. So this $6,000 deduction was an attempt to try to make up for that. Now, I don't know why they didn't just raise these thresholds. I would have thought that would have been a better idea, but who knows? The legislative process is always messy. There's always compromises, and things always do not work out in the way that is necessarily the best way for taxpayers. So,
And Steve, that is actually one of the areas where widows gets that caught up
mm,
because on a single
yeah,
level, maybe they didn't have as high Social Security taxes incurred, But when they find themselves as a single person, I'm sorry, as a joint person, they didn't experience it. But as a single
Hmm.
person, all of a sudden now they find out that their Social Security is completely taxed.
That's a great point. And that's another issue too, is when if you're a widow or a widower, you have want to look at that, your taxes again, because you could be getting hit by a lot of things you would not have gotten hit by when you were married. So that's a really important point too. So, and there's also an increase to the SALT cap. Now that, of course, if you're in a zero income tax state with low property taxes, this doesn't really mean a lot to you. But if you're in a high tax state like New Jersey or New York or Connecticut, this does mean something for you because they increase the SALT limitation, which is a limitation on how much you could deduct for income tax and property taxes from 10,000 to 40,000. But again, it's subject to a phase out. And so we have to be cognizant of that phase out. And by the way, this is going to disappear in 2030. So they only did this for about 5 years effectively. I'm hoping they extend this, and I'm actually hoping they raise it further. But by the way, this is adjusted for inflation. Whereas I don't think the $6,000 senior deduction is, but this is adjusted for inflation. This $40,000 cap, I believe. Yep. Okay, and so there is a limit on itemized deductions. Also, you lose some of your itemized deductions, and you're in a 37% bracket. I'm not going to get into a lot of details here, but again, this is something we would want to look at, and if when we look at your taxes year by year and see whether you're going to lose any of your itemized deductions. It gets a little complicated regarding the formula here, which I'm not going to cover, but this is another way that you can end up paying more taxes than you expected if we're not careful. Okay, so we have actually a couple that are working, and here you can see the numbers, what their tax burden would be. If you're making 250,000, their income is 250,000, and you see the federal taxes and New Jersey state taxes. Now, I revised these slides for New Jersey. I know Florida doesn't have an income tax, obviously, and FICA. So they're going to have 61,000 in tax, and they're going to take home about 188,000. Okay. Now let's just see what happens when they retire. Early retirement now, they're going to have 40,000 in Social Security income, perhaps a $50,000 pension, and perhaps 100,000 in capital gains because they need to fund their retirement and they had to liquidate some of their investments. Their total income is 184,000. Their federal taxes are 11,000. Okay. And their New Jersey state taxes are substantially lower than they were. And they don't have FICA any longer. So they'll owe 14,000 of tax, and they'll take home about 170,000. Okay. But what happens if later on in retirement? Now, this is the big issue here. So they have 40,000, the same income basically, but now they have less in capital gains because they didn't liquidate as much of their taxable investments because guess what? They hit age 73 and now they're forced to take money out of their IRA, the required minimum distribution. So now their income's up to 204,000, but because that 70,000 is all taxed as ordinary income, by the way, as opposed to capital gains, which is taxed at a 15% bracket. Now their taxes go up to 22,000, and even though their total income is 204,000, they don't end up with that much more money than before they started getting their RMD, which is interesting. And
And I just
they end
want
up
to
with
say something about
yeah, go ahead.
the New Jersey state tax. It really doesn't matter whether you're in a state where there's state tax or not state tax. It's the
Yep,
same type of phenomenon that we see a
yep,
lot of people in the later stages of retirement, even in the earlier stages of retirement, that did not withhold enough money in their taxes and therefore have
yep,
to actually pay out taxes. And that can become a little onerous, especially if most of your assets are in retirement accounts, because now you
yep,
have to take out additional money out of your retirement accounts, which is, guess what? Ordinary income taxed.
yep.
And so it only increases your taxes further. So
It's like a
this is
snake
a
trying
part
to,
of
bite
what,
its own tail.
right, we're trying to help you
Yep.
prevent that.
And by the way, this also becomes subject to the phase outs I mentioned here earlier because those IRA withdrawals are treated as ordinary income. So you may lose the SALT deduction. You may lose the senior deduction, the 6,000 per person. Also, by the way, you could get hit by the increased Medicare premiums as well. So this is we're going to lead up to something here, and that Laura's going to cover why it may be important to make some moves at the right point in time to help alleviate this issue, or at least diminish its effect on your tax in the future.
Okay, so we're
Okay.
we're going right into the whole idea of tax diversification as being the mistake number two when people don't try to do this. Tax diversification is an interesting concept. A lot of people have heard about investment diversification, which is the next slide, which it shows on the left-hand side a 60-40 model, although we're showing a 50-50 model. Everybody
Right.
that has ever listened to us knows that we think that this is an outdated type of model on the left-hand side
Yeah.
and doesn't adequately protect you. We believe in much more diversification, even much more than what's on this current slide on the right-hand
Yep.
side. But suffice it to say, we want to diversify. Why do we want to diversify in investments? We want to reduce risk. We want to reduce risk by creating more flexibility and control, number one. And number two, by maximizing the opportunity for return for any given level um, of risk. So that's
Yep.
so what is tax diversification? Well, tax diversification is essentially the same thing. We want to reduce risk. How do we do that? Once again, by giving you more flexibility and control. What is the flexibility and control all about? It's about flexibility and control over changes in your own life situation as well as
Right.
changes in tax code. So
Yep.
flexibility and control is the first piece. The second piece is the opportunity to minimize taxes for any given level of income over time. So
Yep.
it's really
Yep.
the same concept. The diversification concept is very important in taxes. So a lot of people, in fact, the majority of Americans have most of their assets financial assets in qualified accounts.
Hmm.
And the qualified accounts can be significant. So somebody might look at their IRA and say, oh, look, I have $1 million in my IRA account. Well, that's great. However, you think that you have $1 million. You really don't because you're going to be taxed on that. If you're
Yep.
in the 24% bracket, which is kind of the middle of the road tax bracket that many people are on, you can figure that you really only have $760,000, not $1 million, because as you take it out, it's going to get hit with those taxes. And so it's important to understand that
Yep.
that situation is not always ideal. So, what do we try to encourage people to do? Again, I was just talking about that middle bucket. Generally we think of three buckets: the qualified
Yep.
IRA, 401k, SEP, all those different, the IRS does a great job at encouraging us to save this way. They give us incentives um, to put money and accumulate assets in these buckets, this middle bucket. But now it's all taxed as ordinary income. Um,
Yep.
Whereas the tax advantaged account, which is on the right hand side, it's the burgundy bucket here, that is actually a beautiful asset because you're putting money in not you're not receiving any kind of tax break when you put money in, but it grows tax deferred for the rest of your life. And then when you take it out, if you take it out, you're not required to take it out of this bucket. You are required to take it out of the middle bucket. If you take it out, it will be tax free. And the
Yep.
first bucket, all the way on the left-hand side, this is your standard brokerage accounts, your taxable money. This money is not impacted by when you take the money out of the account. It's impacted by what occurs inside the account. So if you sell a stock and you have a capital gain or a capital loss, if you receive dividends, if you receive interest, you're taxed that year. And so it doesn't really matter whether you've taken it out or not taken it out. And so these different tax treatments, um, you should be aware of it and you should be
Yep.
using it to your advantage. And so one of the things that we talk oftentimes is creating, if you can possibly create these different buckets. Sometimes it's hard, especially depending upon when you actually come to talk to a professional like Steve and I. We might not
Yep.
have as much time to, but if you could click on the next slide, Steve.
Yep. I just want to mention one thing is that if you're still working and you're in a really high tax bracket and your company does offer a Roth 401k, you may not necessarily want to do the Roth. You're in a 37% bracket and you there's a good chance you may be in a lower bracket when you retire. You may want to do the traditional 401k and not bother with the Roth. But if
So,
you're in a low
Steve,
tax
that's
bracket,
interesting. I would argue with you. I would
yep.
say it really does depend.
Yeah, it
How
does
much
depend.
on the cusp are they in
Yep.
terms of changing their overall marginal bracket? How much
Right.
money do they already have in the qualified account?
Yes,
Do they have other
absolutely.
assets? Is there a pension? These decisions, this is not these financial gurus that say everybody should be one way or
Nope.
the other way. It really depends. I had a woman
Nope.
recently ask me, she was 80, and she asked me, does it make sense for me to do Roth conversions? And, we talked about her overall situation, and it turns out she has so many assets. She doesn't want to do RMDs any longer. She
Hmm.
has longevity expectations in her life, so she thinks she's going to be around for a fairly long time. Her children are in high marginal brackets, so when they inherit the money, if they have to take money out of the traditional IRA, they're going to be a problem. For her,
Over
it
10
makes
years.
sense for her to do a Roth, but
Right.
not everybody. It really does
Nope.
depend, right?
Yes. And when I mention what I mentioned, that's just a general idea, a thought. And Laura's right. It's much more complex than what I started to allude to, but it's just something you need to consider. You should go to somebody who's a tax professional like us who understands the
This is
the
what
issues
we do
around
all
this.
day long. This is
Yes.
just with all of our
Yep.
clients. And um,
Yep.
so I don't even know if some, truthfully, CPAs go to the extent of the analysis that we do.
No.
Ideally, you want a comprehensive financial advisor that has a tax specialty, such as us, and that pays attention to your taxes. Um,
Well, somebody I know once said that accountants bayonet the wounded. They
Well,
tell you what.
they're
uh,
usually more focused on the reporting and recording of the taxes as opposed to the strategic planning
that's
aspect of
correct.
it. Some
Exactly.
are though. I don't want to badmouth
Not all. You're
all
right.
CPAs, but you really need
Yeah.
to make sure that you have a professional that can help you with this.
And
So,
we'll work with your CPA, by the way, too. To assist them to make sure that as a team that we're getting the best result for you.
so as I was saying regarding this diversification structure, the first thing is to create that overall structure where if you can either pre-plan before you're even nearing retirement or even as you near retirement, if there's opportunity to do Roth conversions or to maybe reduce, sometimes it doesn't make sense
Yep.
to put any more money in your IRA, believe it or not.
Yep.
I dare say that. Um, Sometimes it makes more sense to, instead of saving in that vehicle, to put it in a taxable account. And so, understanding that whole overall structure and getting that right is key. The
Yep.
second component is, okay, now that you have your different tax buckets, how are you going to allocate the asset allocation? Remember that diversified investment strategy that we talk about? How are you going to put the different investments into those buckets? So, do you put, for example, I actually saw, Steve, somebody with municipal bonds in a qualified account, which was a horrible
Oh,
solution. Municipal bonds create income that is tax free. They're
right.
beautiful. Municipal bonds are a beautiful thing for your taxable account because when
Right.
you create income, they're tax free, as opposed to corporate bonds, which are taxed
Yep.
at ordinary income tax. But what made this situation even worse was that not only did she not get the benefit of that tax free opportunity, when she went to take the money out, it now was all taxed as
Yeah,
ordinary
that's
income, which
right.
is completely crazy. So making sure that you place your different asset classes in the appropriate buckets, those asset classes that are kicking off ordinary income should be buried in the qualified accounts. Those
Yep.
that maybe have capital gains or even are more efficient, like an ETF, or you're working with a group like Steve and I, where we're doing tax loss harvesting and we're managing it, that can be in a taxable account. But you need to make sure that you understand that. And
That's
then
right.
the third piece is, okay, now it's time to take money out. You've saved, you have a great nest egg, you have plenty of money to enjoy, but what is the best way of taking it out of your account? All really need to be thought through and strategic in the way you do this.
And with this, that actually leads into the next part of this presentation. Unfortunately, when you have RMDs, you're losing some choices. You have no choice but to be forced to take money out of the IRA when you hit age 73. And I think the
Or
initial with
75.
I'm sorry,
If you're over
yeah,
60, over
yep,
75. So it's
yes, yep, that's correct. But people below 60, it's 73, right? But I think the first year withdrawal is around 4 to 5% of your IRA. So that could be a pretty significant number. You have $1 million IRA. Now you have to pull 40, $50,000 of it out, and it's all ordinary income. So, and you're going to be forced to do it, And then, as I mentioned earlier, it's going to affect your marginal bracket. It's going to affect some of the phase outs. It's going to affect whether you get hit by additional premium on Medicare, which is called IRMA, which I always forget what that stands for. Maybe perhaps you remember, Laura.
I don't
Uh,
even try.
I
Also,
know.
the senior
Yeah.
deduction. But Steve,
Yeah.
can I just say one thing? I said
Yeah.
60, I meant 1960. If you were born after 1960. Um,
Okay.
yeah,
Yeah.
so I misspoke.
That's okay.
Sometimes
It's
I catch
it's
myself.
yeah. So I do too sometimes. I catch myself. So yeah. So yeah, it starts at age 73, for except for some people. And so what happens though, your RMDs grow because it's based on your life expectancy, and the IRS uses a uniform life expectancy table. And you can see what the IRS is saying. By the time you hit age 100, you should have pulled all your money out of your IRA for the most part. And so what they're doing is they're kind of recovering the tax on the that you deferred all those years by forcing you to this money out of your IRA. And so, as I said, it's about age 73 is about 3.5%. So I misspoke there. But when you hit 75, it's like 3.7. So it starts to get up there. And
With also for our clients, with if you're appreciating enough in terms of your portfolio, it
yeah,
gets even more onerous. And
yep,
I do want to say something about my widows. This again, when you have RMDs and now you've inherited them from your spouse because they've
hmm
passed, you're now really having a problem because there's so much money that's coming out. And now you're at that single bracket level,
that's
but you
right.
still have that high income.
Yep. And you have a smaller itemized deductions, roughly half,
Hmm.
or standard deduction, I meant to say. So, no, that's a great point. And if you have medical expenses, now you have a higher threshold to cross before they're deductible as well. So, yeah,
There are planning things you can do, especially
there
if
are. Yep.
in the year beforehand, for example, if you know that your spouse is ill or your spouse is significantly older than you,
Yes.
but all even in the year of death, if you're a qualified widow, you get a year to kind of set things up better. So that sometimes is an opportunity to do some things like Roth conversions.
And there's another opportunity there too, which a lot of people are not aware of. If you have a joint account with a lot of investments that have high embedded gains in them, and if you can separate that account, and if one of the spouses, you have to outlive a year for this to work. But if one of the spouses, is not healthy, it may make sense to put those investments with a low cost basis in that spouse's account. So you split up the taxable account into two accounts, and a spouse that may have health problems, put the investments in there that have a lot of capital gains. And the reason is you're going to get a step up in basis at that first spouse's death. So it's another little planning trick
We've done that
that,
once or twice, right? Yep.
yep, yep. So, and also, by the way, spending in retirement is not consistent. We know that. There's a lot of lumpy expenses that we usually always incorporate when we plan. And so it may look a lot different. A lot of people, by the way, thought that people spending in retirement drops as they get older. That may have been the case 20 or 30 years ago, but people are healthier now. So people are still traveling, even in their 80s. We still see people buying cars and traveling and doing other things. So that old that stereotype no longer exists. But it's going to be years when you're going to need to spend a lot more. You may need to purchase an automobile. Well, you might have decided to take a 40, $50,000 once in a lifetime trip, you know. And so your spending is not going to be consistent. We know that, but we always do our best to try to include that lumpiness in your expenses when we run our projections. Okay, sorry about that. Okay. And of course, I mentioned this earlier, these RMDs, which you have really no control over, you have to take them, create tax on income you really don't need. And we find a lot of our clients end up taking that money and putting it right in their taxable account. They really don't even need it. But unfortunately, they're still being taxed on it, you know. And, Laura brought up a great point. If you have to pull the tax out as well, that's also considered to be a withdrawal. So you have to watch that. If it could be, you can almost be like a snake chasing its tail. You have to pull more money out, means you have to pay more tax. It means your tax bill goes up, means you have phase outs. So you have to really be careful with this.
Yeah, I'm thinking about one client right now that we've been working with, that every year we're trying to catch up and fix the fact that um,
Yeah.
because we keep just creating more tax problems going forward. But all their money is IRA money. Absolutely everything is IRA money. There's nothing else we can do.
Yeah, that's rough. So another thing you can take advantage of, a qualified charitable distribution. And what you can do is you can actually make a charitable contribution directly from your IRA, by the way. And it's for people over 70 and a half, and the transfer has to be direct to the qualified charity. So in other words, you can't get a check in your name and then donate it to the charity. It has to go directly to the charity. And also 401ks and 403bs are ineligible, and you can actually do $100,000 per person per year. Okay, so if you're charitably inclined, this may be a better way for you to contribute a lot of money to a charity.
Can I clarify this a little
Yeah,
bit because I think it's a little so at 70 and a half, when you're not required to take required minimum distributions yet, you can
yep,
start doing this. And
yep,
in 2025, you could take 108,000. It's indexed every year. Since 2024, it's been indexed every year. You can take it out and do that conversion directly to the charity. You don't take ownership of it. It just goes directly to the charity. And that is a great way of reducing future RMDs and
yep,
also reducing your estate if you think you're going to be in an estate tax situation. However, there's a whole second way of doing this qualified charitable deductions, and that's when you're forced to take the money out anyway. So you're required to take the minimum distribution at age 73 or 75, depending upon when you were born. And instead of it normally hitting your income tax, which it normally does when you take it out, it's a way of diverting it to the charity without recognizing it as income. So
yep,
the first way is you weren't required to take it out, but you still want to do it anyway. The second way is you are required to take it out. So it's just a matter of whether you want to get hit with the income tax or not, whether you're charitably inclined or not. If you're giving money anyway to your church or your synagogue or wherever,
yep,
might as well do it that way. And we have a lot of folks that do that.
yep. Can make a lot of sense based on your overall circumstance, and it's something we can incorporate in your planning and make sure that you also are not hurting yourself by giving away too much. We can project this for you.
Okay, and the last mistake that we want to talk about, and believe me, these are not completely comprehensive. There are other mistakes as well. We're just focusing on these four that we see all the time. And
Right.
this is when you're talking about estate planning, handing over a big bill to your children. And it all stems from the fact that you have different types of investments, but that tax deferred account, again, that account that was so um, cherished on in your accumulation phase is the account that creates the problem. Your tax advantaged account, well, your heirs will be required to take money out of that account over a 10-year period. It's not taxed. So that's a great thing. Your
Yep.
taxable account, while there are no RMDs, and in theory there's income tax, but the truth is that if you pass along appreciated assets, it gets a step up in basis. So that's not taxed either. It's really
Right.
that tax deferred account that's the problem. And
Yep.
so you
That's
want to
correct.
understand the marginal bracket of all of your children and any of the heirs that you might be leaving it to. So this example just gives, you might have a child that is a doctor in a high bracket and another child that's in a low bracket that might be maybe a public teacher or that kind of thing. And
Yep.
so, how you want to leave the money, most people say, I just want to leave it equally to my children, one third, one third, one third. But if you look at this split, this shows an example where somebody has a $300,000 taxable account and a $600,000 IRA, and they do one third across the way. But you'll notice that Sarah's tax liability is a lot higher than Shane's because
Yep.
she's at that higher bracket. So that's generating more taxes, and she's actually they're all paying 146,000. So your children only get 754,000 out of that 900,000 to actually use. As
Yep.
opposed to if you actually did the analysis to figure out, well, let me give Sarah just the taxable account because she's going to get the step up in basis. And so she's not going to get taxed at all. Give Shane the majority of the IRA because she's being taxed at that lower amount. And I can even out the overall tax uh, after tax inheritance, where
Yep.
they're actually paying $38,000 less in taxes and receiving $38,000 more. One
And
of the
so,
things that's not included in this analysis is charitable. If you have a, a beneficiary is a charity, you
yeah.
also want to think about perhaps leaving your IRA to the charity because the
Yep.
charity has zero marginal bracket. So they're the ones that should receive the IRA. And the second consideration that's not on this slide is if you have a special needs child, because there's a
Yep.
special unique provision for special needs children. They can receive an IRA and they can stretch it throughout their lifetime. You may have heard of the stretch. That was before 2020. There was such a thing as
2017,
being able to
20,
stretch your
2020.
IRA through your lifetime. No
Yeah.
more. That has gone away. It's now
Yeah.
10 years you're required to take it out. But if you're a special needs child, you can stretch it. You don't want to get impacted. Their special needs benefits, SSI, or anything to be hit. So the special needs child should get the IRA, and the other children should get the other benefits. So
So,
you need to understand the marginal brackets of each of your
yep.
heirs.
So there's a couple of psychological issues here. So works great if you speak to all your children and they're willing to give you this type of information in terms of their marginal bracket. But you also want to counsel your children, explain to them, and give them an overview. So look, we're leaving more money to Sarah because she's going to get the IRA, but ultimately you're all going to get the same amount of money net of taxes. So you want to counsel. I should say taxable portfolio for Sarah. You want to counsel them and make sure they understand that you're not necessarily trying to favor one child over another, and you're just trying to make sure that they each end up with roughly the same amount of money net of tax. Now, we created a spreadsheet which we used for some people about a year ago to help even this sort of process out. And we did, I think, a 10-year projection in the spreadsheet because that's the time over which you have to have pull all the money out of an IRA. So we can help you with this, and we have pretty effective tools to help with this decision. So
Right, which is why the other thing that I want to mention when we do estate planning, a lot of you know if you're a client, that we do a preliminary estate analysis where we help you figure out what you need to talk to with your attorney. We then encourage you to go see an attorney and sometimes
yeah,
bring us. We really like you to bring us, but if you
yep,
don't bring us, we want to look at the documents afterwards because I have yet to see an attorney that understands this issue. They just don't. They don't look at people's tax situations. And so
they
this
don't.
is a place that we can add value and why we want to be one of the many reasons why we want to be part of your estate planning process because we
Right.
can add value to it.
Yeah, it's absolutely right. Yep.
So regard with when we look at the overall tax situation, when we're working with you, we're looking at your tax return. We're creating annual pro forma statements every year. We're looking
That's
at where
right.
we're placing assets in your accounts, whether they're taxable accounts or qualified accounts. We're trying to capture losses. If you have assets in a taxable account, we work on trying to capture losses, and we have some tools that can even accelerate losses and supercharge the tax loss harvesting,
That's
which is
right.
wonderful for those people that have significant capital gains. We
That's
use
right.
ETFs in a way that can be more efficient in the areas where there is already investment efficiency, so we can be more tax efficient. We try to use an optimized bond portfolio that will use municipal bonds when appropriate, where appropriate. Um,
Right.
Treasuries instead of a money market help with state income taxes, particularly in New Jersey.
Yep.
Options will help cover a very risky situation when there are capital gains taxes. And we have some private placements that even help with ordinary income taxes, which are very interesting for our higher earners.
Yes.
So we're always looking at the tax situation, and you should be too. It's really important because while none of us, we all want to do what we're supposed to do, we have an obligation to pay taxes. We certainly don't have to pay more taxes than we need to. So we recommend that you pay attention.
Yep. Absolutely. Look, I always believe it's you can spend the money better than the government can. So we'd rather have you have it. And your children.
So that's really all we wanted to talk about in terms of taxes. If anybody has any questions regarding their taxes, if you haven't gotten us your return recently or haven't done a pro forma, please give us a call and come right in. We'd love to sit down and make sure that we're making some good choices before the end of the
Yeah.
year. So thank you, and until next time.